I want to talk about this Prosperity Capital Fund. I'm really, really excited about it. And what happens is I feel like I can't explain it really well to what we have going on. With Prosperity Capital Fund, we've set up the ability for people to invest in a fund. It's almost like a publicly traded company. It's a CF fund. So you put money in and then you're going to buy shares in the company. So we've already got money in the company. So it comes in and then we take that money and we go invest it in things. So usually it's houses or things that pay back cash flow. You know, we created the brand Buy Income, and the Buy Income concept is you put money in something and you want a cash flow coming back, right? And so that's why I like this. It's not like buying a stock. You're going to invest the money into something, then we take it into the things that we go invest in, and then we're going to turn around and invest that money, make a profit, and it comes back to you.
And the only thing I've seen you do is really just houses, right?
Yeah, well, that's what we know. We know well. We've done a couple different things before this, though. So we went in and we bought equity in a business. We put $100 grand into business, but we always set it up where we're getting cash flow. So they paid us an 8% return. And then what they did is they paid us that 8% return. And then in the end, they sold the exit of that company and they paid us back $100,000 in profit. So we got 8% return and $100,000 in profit. That's an example of something we did outside of the fund. This was leading up to the fund. So there are things like that we're going to explore when it comes later.
But the houses are so secure because you're only putting
You're
like
right.
70% of what the house is worth.
You're right. And so what we've done with this is when we're paying to the people that invest in the fund, we'll pay a pref of 8%. So you're getting 8%, and then we're going to split the profit after that. So the goal of that is to make as much money as we possibly can for the fund. Now, what's interesting about it that I don't think people understand is if you put in $100,000 and we took that $100,000 and deployed it and it made money, it would come back and it would disperse all the way through, right? And so it would pay back. Well, what happens is once new money comes in, now all of that money is working to make a rate of return. So which means your money and their money is now collectively making a rate of return and then passing it through. So it's almost like the money is employees.
But I think the part that I think you need to be clear on, I mean, I know I've invested in it and you're saying you're getting a minimum of 8%. I've never gotten anything less than 12% back. So I think you need to say, yeah, the minimum is 8, but I know for me personally, I've never gotten anything less than 12.
You know, you're helping me bring up a really good point. And the point is that's IFC. So with IFC, we take that money and we invest it into homes and we pay back a set 12%. But the beauty of the capital fund is you're splitting the profit above that. So which means if we charge points, if we charge 20% or whatever we charged on the capital of this fund can be greater than that. So one of the loans we did, we loaned the money out from the Prosperity Capital at 20%. And when we loaned it out, it came back, they get a pref of 8, and then we split the other 12%, right? So now they're ending up with 14% rate of return, which is a greater rate of return. And so ultimately, there's different ways and different opportunities that we have. So you have IFC, then we also have the Prosperity Capital Fund.
And right now, I mean, like if you go into a high return savings account, which by the way, I like to tell people, if you just put your money into a savings account at like Chase, you're getting 0.01%.
Yeah.
And then the highest that you go, if you're going into a really high savings return account, is around 4.5%.
That's right.
You know?
Well, and so if interest rates keep coming down, then that's going to get squeezed more, right? And then we have the volatility of the stock market. And so all of those are things that are concerning. And so what we have is this unique opportunity with the fund where we can go in and supply it to the houses like you mentioned. So we can build this CF fund up to about $5 million. That $5 million is rolling, and however much money you have in it is your equity stake in how much money that money makes. And so you're getting 50% plus the pref on the money we make.
Well, I think the thing I like is just kind of how conservative you guys are in the sense of like, you are not loaning the money to anyone that, you know, even on the flips, you're only giving 70% of the house value. Right. Plus you're not even giving the repairs. The person has to have the money for the repairs. You're working with people who have high, they've already done this before. They have money in the bank. There's just so many check boxes that you guys do to make sure before you put the money in someone, you're very conservative, and I like that.
The value of this with Prosperity Capital is you can put the money in there and you don't have the friction going back and forth. So when you put it in there, it stays in there, and we put it into a property with IFC or something like that. We loan it to ourselves is where you're going with that. And so we do that, and we've done that over and over and over again. We've also got, even when we're doing something that, we have a couple little fail safes, right? Like, so we set up a little check and balance that if we purchased a property or we gave a loan to a property, and that property, we looked at the borrower, we looked at the house, and both said, hey, they're great. Well, the borrower, for whatever reason, defaulted. We would take that property back, and then we would go sell the property because we have the ability to dispo to other investors. So we just resell it to another investor, get the cash back, put it back into the fund. So
And then they don't have to deal with that.
they don't have to do with any of that. That's
don't
what I mean.
have
It's
the
less
headache.
friction. Yes, exactly. So that's the advantage of the capital is it has less friction. The capital fund is less friction. You have IFC, you have the capital fund. Either way, it just depends on what you're looking to do. It's just hard for me to be able to convey to them what this fund does because when we're explaining it, they don't necessarily see what they're going to get. But I like the idea that it's quarterly distributions. It's going to go to monthly distributions is our plan. And then once we're flowing with that, the more money is in there, the more it's just rolling off and spitting off more and more capital.
Well, I know for me, one investment I recently made, I did $100,000 into a multifamily thing.
Oh boy.
And I'm not joking. After a year, I made $166. That's it. That's all I made. And I'm like, how did I get suckered into that?
Well, it's not that. I mean, ultimately, I think
Hopefully it will end up working out, but it's
I
still
think you're
annoying.
good because I know that investment is secured by real estate, right? And so I know that it's not something that we offered as an opportunity, but where I'm going with that is that your money is going to be okay. I think your rate of return is different than you anticipated. And that's what stops people from looking at prosperity capital because they're not sure what to get. And that is the problem with any of these investments is you're not sure what it's going to do. So we've set it up. I'm excited because it's moving. We've already done distributions. We know those rates of return. But because of it being like a publicly traded company, I'm not even allowed to say what that stuff is.
Wait, but let me ask you a question. If the money is just sitting in the bank and you're not actually deploying it at that time, then what is their rate of return? Still the 8 or they don't get anything?
They wouldn't get any. They're getting the first 8%. And that's the challenge. That's why. So we have to be constantly moving it. So the challenge for me is I have to both get capital coming in and find the other opportunities. But as you know, even if we had to do IFC or something like that, then we have an opportunity kind of constantly coming through. So the money coming in doesn't sit there because then we don't make any money. So if there was money sitting on both sides, money sitting in the bank and money making money, the investors, both of them are getting paid out. Even if the money's sitting on the sideline, they're still getting paid up to 8% before we would get any money at all. So
but if it's
we're
just
not doing it to
sitting
not
there,
make money.
If it's just sitting there, then nobody's making any money.
No, see that if all of it was, but that would never be the case. So like all the money we have in is deployed right now. There's a couple $1,000s sitting in an account because we just don't have something to put $4,500 in. So, but ultimately when money comes in, we put it out quickly. But what I'm getting at, see, this is why it's important to explain this, is if there was $100,000 and it was going to make 20%, for example, so now you're going to make, well, just easy numbers. We'll say it's $2,000 a month. Then that $2,000 is going to come in. Then the $100,000 people are going to get paid out their distribution, the 8% plus the 50% after that. Okay. If another 100,000 came in and it sat on the sideline, all right, now you got 200,000. Then what's going to happen is both of those combined gets the payout of the $2,000. We just wouldn't get anything unless it at least gave them 8. But we would never leave that 100,000. We want both 100,000s bringing in 4,000 in this example, so that way we're paying them a great rate of return. I think the bigger thing with it is to understand we have opportunities that make money that we can secure in real estate or different things that make value that we're already doing with our own money. So we've set this up to roll and to make money. But this is only the beginning. This has to drive, and we're driving this to make money for our investors because this is a $5 million fund. The target is a $250 million Reg A fund. So we want to do well with this so that we can move. Like I mentioned, we had a capital fund that we did where everybody had shares or had ownership. And now we have this where they have shares. And then we'll move to the other one. But this is just kind of baby step number 2. We're like driven. It would kill our whole vision if we don't get this one operating where the investors are like, great, you did a great job on this. And now we can move to showing the pro forma for our next opportunities.
Got it.